when I got into real estate when I was 18, my life was not good. I mean, I didn't have any money. I was working as a used car salesman. And so to me, it's like, look, I if I decide to give up, I don't have another option. It's not like I have a rich family. It's not like I have rich friends that could help me out. It's like, look, if I give up, I'm staying like this for the rest of my life. And so I just kept at it. I remember at one point when I was in my first 12-month journey in real estate, when I didn't get a single transaction, I wanted to quit every single day. And one day I was like, you know what? I'm just going to quit on the idea of quitting. So quitting is no longer on the table because I just quit on that idea of quitting. And so now it's like, if I can't quit, what can I do to make money in this business? And so I just kept at it. And then again, it took 12 months, but then I finally started making money from it. And so, and now it's like I look back over my life and it would be so much different had I decided to quit at that time when things were not looking good.
This is Real Estate Vibe Show, and I'm your host, Vinki Loomba. And today I have my favorite guest and my good friend, Abbas Muhammad. Welcome,
Vinki,
Abbas.
thanks for having me on. I appreciate it.
Oh my God, I'm so excited to have you here.
Thank you. We were supposed to do this all the way back in November or December, and I had to reschedule and just kept getting pushed out. So my apologies, but I'm glad we're on now.
No, I'm so excited. I finally made it, And after a huge conference that we had together last month, that was a great success. We'll talk about that a little bit. So a little bit about Abbas. Abbas was born and raised in Iraq, coming from a very humble background and sleeping on concrete floors due to his family's limited financial resources. At the age of 11, he immigrated to the United States. And when he was 18, he decided to break into real estate industry. With only 5,000 credit card to his name, he funded his startup costs and spent full year making thousands of cold calls a day to generate clients. After calling many potential clients daily for a year, Abbas finally secured his first listing in Bay Area as an agent. In the following year, he became one of the top producing agents in the area. Abbas was not satisfied with his buying single-family homes or stocks that he decided to invest in multifamily apartments. Within a year, Abbas invested in over 500 apartments in top-performing locations and founded Model Equity with the mission of reaching $1 billion in assets under management in the next 5 years alongside the investors. Today, we'll discuss with Abbas how to understand numbers in underwriting from start to finish, because that's one of his specialty, because he's really good with numbers. So Abbas, first of all, thank you for being with me today. And by the way, great bio, great story, love it.
Thank you. Thank you for having me on.
Yeah, of course. Please briefly share with me, your whole story and how did you end up here, or how did you become whatever you are today?
Yeah, so it's interesting. Like I said, I mean, growing up, didn't have a lot of money. Actually, we were very broke. And then after the war, came to the U.S. when I was 11 years old. And by the time I was 18, I was just dissatisfied. I was not happy with what we were doing. And so I decided to get my real estate license, went all in, and I thought I was going to make a lot of money. I thought it was going to be easy. Everybody thinks real estate is easy. Then I got in, and I failed miserably. Literally 12 months, I was calling 12 hours a day, and I didn't get a single transaction for 12 months. But then afterwards, I became one of the top agents in the Bay Area. I was 20 years old at the time. I was making about $350,000 a year. And then I learned how to hire and how to scale. And we went from 350 to 750 in profit, and then went to 1.7 million the following year, had 25 virtual employees and everything. And so the business was doing really well. I became top 50 in the country with Remax. But then I decided, I wanted to start investing my cash somewhere. And I knew I didn't want to get into single family because I saw how much my clients were working on these passive single family house investments, and they were not passive at all. And so I was like, you know what? I definitely don't want to do single family. I don't want to do stocks because I just don't get it. Actually, I threw 180,000 in the stock market. It went down to like 130, and then I sold. And I'm glad I sold because now it would be worth even less. And that was just S&P 500. So I quickly realized I'm not a stock market investor. I looked at crypto. It never made sense to me because I couldn't see how they were valued. And then eventually I found out about multifamily. And that's when I realized that multifamily was the way to go for multiple reasons, which I don't want to go too deep into right now. But it's like the value of the asset is based on its income.
Mhm.
And so I could analyze it, I could touch it, I could look at it, I could look at the tenants, I could look at the income that it produces. And so I could see a way of evaluating these deals. And so I decided to go all in, invested passively with other people at first, and then I started buying my own deals. And so now we're at 54 million in assets, and like you said, my target is to continue to grow that. I think this year maybe we'll probably add another 100 million to that, and so I'm constantly looking for deals.
Wow, congratulations. Super excited for you. So, one question here, that tenacity and grit. Oh my God, where did you get that?
Yeah, I don't know, to be honest with you. It's when I just remember when I got into real estate when I was 18, my life was not good. I mean, I didn't have any money. I was working as a used car salesman, and so to me, it's like, look, I if I decide to give up, I don't have another option. It's not like I have a rich family. It's not like I have rich friends that could help me out. It's like, look, if I give up, I'm staying like this for the rest of my life, and so I just kept at it. I remember at one point when I was in my first 12-month journey in real estate when I didn't get a single transaction, I wanted to quit every single day. And one day I was like, you know what? I'm just going to quit on the idea of quitting. So quitting is no longer on the table because I just quit on that idea of quitting. And so now it's like, if I can't quit, what can I do to make money in this business? And so I just kept at it. And then again, it took 12 months, but then I finally started making money from it. And so, and now it's like I look back over my life and it would be so much different had I decided to quit at that time when things were not looking good.
Oh, I love that. Quit the idea of quitting. Because
Yeah,
see, what happened is when you're very close to your target, most of the time people give up at that time.
yeah,
And you
because
didn't
it's
give
hard.
up. And that's the reason you're here today, which is awesome. And
Yeah, and
then,
that served me really well many, many times. Like, throughout growing my business, I remember during COVID when everybody else was shutting down and real estate agents and brokers were reducing their marketing. I was like, you know what? I'm not gonna do that. I'm gonna do the opposite. I went all in. In multifamily, when I would get in a deal and maybe raising money would be hard or finding partners would be hard, just keep going at it until it gets done. There's no other way around it.
so is it something that you learned from your parents because you're so young? Or is it like something just being young, you have that instilled in you? Oh my God, I'm a go-getter, make
No,
it
I
happen.
appreciate that. It's so my dad spent his whole life working super hard, and so I learned a lot of hard work from him. Um, he was a chef for 35 years and financially struggled for his whole life, and so it's kind of interesting because growing up, it's like I knew the value of hard work, but I also knew that it has to be put in the right things for it to matter. And so I just, like I said, I mean, going in, it's like I want to work hard, but I also want to do something different with my life. And I knew if I was to give up at any point, I would stay the way I am for the rest of my life. And I guess I'm a little more ambitious. And so that's why I just kept at it.
Exactly. And the life is all about choices. It's like there's so
100%.
many possibilities, so many probabilities. It depends upon you and your mindset, what action or what choice is right for you at that time. Everybody tries to do their best in whatever situation they are. They try to make the best choice for themselves. But sometimes, the decision taken in the present, it really helps you in the future. And that's what we don't realize, because most of the people, either they're living in the future or in the past, but living in the present moment and realizing where you are and making the right choices, it helps you a lot. So I'm going to ask you a question over here is, you're really good with numbers. We worked on a conference before, we worked on multiple projects, here, there, and understand the number comes really easy to you. So
Yeah.
how did you acquire that quality? Or is it a skill, I should say, or a quality?
Yeah, I mean, it's definitely a skill that you develop over time. I'll tell you this. In high school and college, math was not something I was good at all. And the reason is because it never made sense to me. Like, why do we need to understand all these different algebra equations that I've never seen anybody use at all in their life, right? Now, people use it, but not, it wasn't real to me because I didn't see anybody use it, right? And so, but I've always loved numbers because of the fact that you can't argue, right? You can't argue, an analysis sheet. If things are written realistically, it's like you could look at a deal and, obviously you could fudge the numbers to make the deal look bad, but it's very obvious if you do that, right? To somebody who's skilled at underwriting. And so right now, when I look at deals and when I underwrite, and by the way, when I first got started in multifamily, I underwrote hundreds and hundreds of deals. I remember every single day I was underwriting for like 8, 9 hours every single day. And so it's a skill. I didn't have it when I first started. It took a lot of time to develop it. And we still change a lot of things as we go along because you want to stay competitive with the market, right? Things are always changing. And so what is true today may not be true in 2 months or 3 months or 4 months. And so we constantly have to stay ahead of the market, see what everybody else is doing, see what brokers are doing, see what's happening with the economy, see what's happening with the lending process, right? And so these things are always changing, but I enjoy it because to me it's real. It's not some equation that never actually materializes in life. It's interesting. Like I look at our underwriting versus what's actually happening at the properties we bought, and it's interesting to see. Oh, you know what? On this thing, we were actually exactly at projections. This we were a little bit off. So next time I need to modify it this way. So to me, it's real, and that's why I enjoy doing it and learning more and more about it.
Yeah, I love it the way you explain it, that if something is not working, you wanted to tweak that in your next underwriting. And a lot of operators, I'm not sure if they translate those mistakes into their next underwriting or no. If they do that, oh my God, most of the deals should work out well. But I'm
You
going to
have
ask you
to.
this question here for our new listeners over here, or the new people who are new to underwriting. Can you explain what underwriting is and why is it important to underwrite a real estate, the investment property?
Yeah. So underwriting is basically evaluating a deal, right? And there are many
Mhm.
different ways to evaluate a deal, but usually in multifamily, you evaluate it on an Excel sheet, right? And the Excel sheet would, you would put in previous income, previous expenses, and then your future projected income and expenses. And so that's really what deal evaluation is at its core. Now, obviously, you'll have, different things that you apply to different deals, but basically what we're looking at is okay, so this is what the deal has been performing as in the past. What can we do to improve it? Can I add in Wi-Fi? Can I upgrade the units? Can I add in a tech package? Can I maybe add a pet fee? Can I add a private yard fee? So you're looking at all these different things. What is inflation going to do to my monthly expenses? What is organic rent growth going to do to my monthly income, right? So you're looking at all these things just to see, does the deal make sense? And so if whenever we're looking at deals, for example, I want to double investors' money. So as I do my analysis, I'm trying to figure out, can this deal double our investors' money? And part of that also, I want them to get cash flow. And so as we look at deals, that's kind of the metric. And I'm trying to see, okay, so if I buy this deal and I apply these different things to it, these different improvements, can we get investors' equity to 2x in 3 to 5 years? And that's really the lens I'm looking at.
Okay, so another question here is, what are the some key financial metrics that are used in underwriting, and what do they tell you about potential profitability? Because you talk about your assumptions or business plan, like what additional things can you add to make money, but what are the existing financials can you use?
Yeah. So there's this thing called the T12, which is the trailing 12. It's the profit and loss statement of the property. So that's very important. You have to have that on the deal to basically see what the performance has been like in the past. You got to think about multifamily deals as businesses. And so these T12s are essentially the profit and loss statement of that business. And then
Mhm.
another document that we look at is called the rent roll, and the rent roll basically details all the tenants, how much they're paying, what fees they're paying. And this is an important factor too that I think a lot of people don't focus on enough is you got to look at when did these people move in, when does their lease expire? And the
Mhm.
reason that's important is because if you see, let's say right now we're in March, right?
Mhm.
And if you look at that rent roll and you notice that there have been leases that are at $900, and then there are leases that are at $1,000, and there are leases at 1,100, you want to see in the past month, in the past 2 months, maybe 3 months, what have been the leases coming in at in the past few months? Because if the leases have been coming in at $1,000, but in the past they were coming in at 800, what that tells me is there's an opportunity to bring all the old leases up to $1,000 at the time of renewal. And so those things can show you very important metrics about what is the current loss to lease, which
Mm-hmm.
basically means what's the current income versus what I could get the income to be at if I bring everybody up to market value on their rent. So these different things, I mean, there's so many ways to add value to deals, and this is just one of many, obviously. But I also look at, I look at the IRR, meaning what is the internal rate of return on the deal? What is the average annualized return on the deal for the investors? I look at the cash on cash. I look at the cash flow, and I mean, there's so many different things, right? I don't want to confuse the listeners, but it is a pretty extensive process. But when you first get started, right, I would recommend finding other people that are doing underwriting, that are looking at multifamily deals, and then just learning the process from them. And then eventually, as you get into it, you're going to underwrite your own deals, and that will help you get better at underwriting.
Yeah, and then you use the terminology IRR, and a lot of people, stumble on that. So, since we're talking about that, let's shed some light on that. What exactly IRR means, and how do you take that into account when you're looking at a deal from a passive investor's perspective?
Yeah, absolutely. So IRR, that's going to be a hard one to explain, even though I've explained it many times before. So IRR stands for internal rate of return. And
Mhm.
basically, what it does is it tells you what the return is on your deal with time, with the value of time thrown in there. So basically, as an example, if Vinky, let's say you invest in a deal and you give me $100,000, and I
Mhm.
tell you, listen, I'm gonna double your money in 5 years, right? So that means in 5 years I'll give you 200,000. But here's the thing: if you look at the average annual return of that, you take 100,000, which is the return you're making over 5 years, that's 20% a year, right? That's the
Mhm.
average annual return. That's what you see on the stock market. That's what you see, on Wall Street. Everybody promotes the average annualized return, which is what is the total return divided by how many years you had it in there, right? In real estate, what we focus on more is this thing called IRR, internal rate of return, where it says, listen, yes, you could double my money, but if you double my money and you give me most of it in the first year, and then you give me only a small piece at the end, then the value of that is higher than if you were to give me most of the money on the back end. And the reason is because of inflation. Meaning, Vinky, if you give me 100, right? And my target is to double your money, meaning I want to give you 200 back. If I give you $20,000 a year to get to 100, then that's 20%. But if I was to give you 50,000 the first year, and then 10,000, 10,000, 10,000, 10,000, right? That will be valued higher, right, in terms of IRR, because the value of 50,000 is more today than it will be in 5 years. So that's why we look at IRR. I know this might sound confusing. It's very hard to explain, to be honest with you, or I'm just not good at explaining it. But the sooner you get your
Nice.
money, the higher the value is when it comes to IRR.
That's true. And it takes the net present value into account. That's what IRR is, because the value of your money in today's state versus the value of your money 5 years down the road. So that's the reason Abbas mentioned that if you get paid upfront, that's the net present value of your money is more, and then the IRR is better. It's a better
Correct.
return on the investment overall, if you
Yeah.
can say that. So let's walk our viewers through the whole process of underwriting. Like how do we calculate the risk, or also the uncertainty, and how do we underwrite or take into account in our underwriting, so kind of make it foolproof underwriting.
Yeah. I mean, there's a lot of things. I would say before you even underwrite a deal, it's important that you understand your deal criteria, because there's so many deals out there. And if you were to just underwrite every deal to find the right one, you'll never get through them. And so you have to first set up your criteria. And I'll tell you this personally, when I look at deals, my number one thing is choosing the market. You have to choose a market. Now, how do you choose a market? Personally, my criteria is number one, I want to see population growth. I want to see higher population growth than the US average. After population growth, I want to see job growth. I want to see, jobs being created, because that means people will be able to make money. So then they could actually pay for the rent and all these different things. So job growth, population growth. Then I want to see rent growth and appreciation, right? If there's a lot of population growth, automatically you're going to see job growth, and then automatically almost every time you're going to see appreciation, and you're going to see rent growth. So that's my third criteria. My fourth criteria is I want a landlord friendly state. I don't want to invest in California. I don't want to invest in Washington or Oregon or any of these states. I want to be in a place where if a tenant doesn't pay their rent, we could evict them, right?
Mhm.
And so those are my criteria. Then the next criteria I have is when it comes down to the neighborhood is if I'm looking at, for example, let's say Dallas matches all my criteria, then it's like, well, okay, not all of Dallas is good. Some areas in Dallas are good, some areas in Dallas are not good.
That's
And
true.
so I want neighborhood criteria to be $40,000 of income per household or higher in that block where I'm investing. That's number one, $40,000 of income. The second thing is I want it to be close to shopping, right? So people could go, get their groceries, get their, whatever medicine within 10 minutes. I want it to be close to schools, ideally, if possible.
It's
I want it
cool.
to be close to jobs, close to a highway, if possible, as well. And I also want it to be low crime, right? Because I don't want to invest again in areas that are in the path of growth, but they have a lot of crime, they have a lot of issues. That will make my life way too hard. It adds extra risk to the deal. So I don't like those type of markets, right? So after you know your market criteria and then you know your neighborhood criteria, anytime you get a deal, if it doesn't match that criteria, if it's not in your ideal market, if it's not in your ideal neighborhoods, then it's easy. You just delete it. You move on to the next one and you keep waiting and you call brokers, right, until you find the deal that matches your specific criteria.
So when we were talking about, what factor or what things to keep in mind when underwriting a deal, and you
Yeah.
talk about the market and the location is very, very important.
Yeah.
So next thing is you already spoke about, the rent rolls or the T12s,
Correct. By the way, another
Yeah.
thing when you look at deals, I think that's very important is you want to look at what is the potential upside of the deal,
Exactly.
right? I mean, when we're looking at these deals, if I look at a deal and I can't improve it, then I'm not going to buy it because it's like, what's the point of buying it, right? If you're
Exactly.
buying a deal and you can't increase rent, you can't reduce expenses, you can't add amenities, then you're not going to make money on it, right? And so that's another important factor. So I have a checklist. Like I said, I have a checklist that I go through on every deal. It's like, okay, can I apply this? Can I apply that? Can I apply this? And if I can't because somebody else already did everything, then I'll just move on and find another deal.
So what are some of the common mistakes that you see investors make when they're underwriting or they miss out on some important things?
Oh, a lot of things. I mean, it's crazy to be honest with you. I remember in 2022, for 6 months, I stayed out of the market because I looked at people buying. I'm like, how are they justifying these numbers? It makes no
Exactly.
sense. So some common mistakes I see. The most common I would say is projections of rent growth, meaning like people look at rent as it is today and they're like, oh, we're gonna take it up 50% or whatever crazy number. And then it's like, okay, do you have comps to show that you can increase rent from 1,000 to 1,500? Oh, you don't have comps. Okay. Have you looked at the average income in that neighborhood? If you were to increase it by 50%, most property management companies want at least 2.5 times of income to rent ratio. And so, do people in that neighborhood make enough money to be able to qualify to rent at your property? And most of the time, people don't even check that. Or if they do, they check the 3 mile radius or the 2 mile radius. And to me, it's completely irrelevant because if you do a 1 mile radius and you cross a highway, it could be a completely different market. The market across the highway can be very high income, but that doesn't mean your specific neighborhood is high income. So to me, it's like 1 mile highway, 2 mile, I'm sorry, 1 mile highway, 1 mile income, 2 mile income, completely irrelevant. You want to look at the income of that specific neighborhood. So that's kind of the most, I guess, common mistake I see is people don't check on those numbers. They put very aggressive rent growth projections for the first year, and they also put very aggressive future rent growth projections as well, organically. So those I would say are very common. In Texas, I also see people commonly misunderwrite the taxes, right? The taxes in Texas, get reevaluated at the time of purchase. And so the way we do it is we go to somebody who specializes in taxes, and so he gives us his expectations, and so that way, we don't have any surprises. In fact, on the property we bought, the tax bill came in $140,000 below what we underwrote. And I'd rather do that to be on the safe side than to say, hey, it's going to be 500 and then have it come in at 700. You know what I mean? Because that could completely ruin a deal.
So how do you incorporate market trends and future projections into your underwriting analysis? And then how does these factors influence your underwriting? Because market trends are really important, especially today's market.
Oh, for sure. I mean, look, if you're buying in a market, you want to know what's going to happen. You want to have a solid understanding of what's going to happen in that market. Like, for example, the reason I buy in Dallas is because I look at the population growth that's happening there. I look at the job growth. I look at the median household income going up. And so based on, and then also you look at what's been happening in Toronto. On average, it's been going up 4.5%, historically every single year. Now, after COVID, it went up like 17%, but that's not sustainable, right? But on average, it does about 4.5%. So that's very important in your underwriting because you want to choose these markets that you're projecting will be able to do better than the US average. And so markets, by the way, that's not just Dallas. There are other markets. You've got Dallas, you've got Nashville, you've got a lot of markets in Florida, like Jacksonville, Tampa, Orlando. You've got Tucson that is doing really well. Phoenix got hit really hard recently, but prior to that, it was doing pretty well as well. And so you've got all these markets that match that criteria. Here's the other thing. When you look at deals, if you don't projections, you probably can't win those deals because you can't get as competitive as other people who are underwriting future projections in there as well. Now, you want to be conservative, right? Like, for example, on the last deal that we bought, the future expected rent growth in that market was about 8.5%, 9%. We didn't underwrite 8.5%. We stabilized it at 3%. Why? Because you want to leave a gap in there just in case those projections don't come to fruition, right? Or to reality.
Great. So let me ask you this question. So when this underwriting that you put together, did you ever get a question from your investors? Like, I wanted to see the underwriting, not just your pitch deck. So in that case, and how do you explain your underwriting to the investor or maybe to the broker? Because I have experience in the past, because the way we underwrote the deal, like you say, we were more conservative side and the broker's number didn't match up. And the broker doesn't want to understand how you're coming up with your numbers, whatever you're trying to show him. So how do you explain that, or how do you get on the same page with your investors or any other stakeholders, whether it's a broker or other partners?
Yeah, so very interesting question. So with our investors, I send them the underwriting if somebody wants it. It's like, you take a look, let me know if you have any questions. Usually the people that ask for the underwriting are sophisticated enough to really understand the numbers. And so they don't really need me to walk them through it. If they want me to, I'll be happy to do it. Right. And sometimes, they might have questions about different things and then I answer them. When it comes to brokers, a lot of times I actually send my underwriting to the broker to justify the price I'm willing to offer. So if somebody, like, for example, I'm flying today at night to go see a deal. I was going to fly today in the morning, but then I was like, oh, we have a podcast. I don't want to delay it again. Let me fly at night. So I'm flying at 11:59 p.m. To go see a deal in Dallas. This deal, I'm not going to say the actual numbers, was listed, let's say, at 27 million, for example. It was listed at 27. I sent the broker our analysis, and by the way, that it stayed on the market. Nobody bought it, so I knew that everybody agreed with me that the price they were asking for was way too high. So anyway, time went by. Nobody was looking at the deal. I called the broker, last week, and I said, "Listen, I'm looking at this deal. I love the market. I love the deal. I love the property, but I just don't love the price. And so we got to find a way to work this out." And he's like, "Yeah, actually, the seller has softened up on his price. What numbers could you do?" And so then I would send my underwriting because I want to show them, hey, listen, although my offer might seem low to you, this is why, because I need the investor returns to be X amount. So that way, I could get investors on board, because if the investors can't make money, nobody's going to invest. And so look, I'm underwriting the deal. These are the comps that we're using. If you have any objections, let me know, but this is what I'm comfortable with. And so then it helps you justify the price you're willing to offer. And so now, we're going in right now and it's going to be like $2.5 million below asking price. And they're open to it because it's like, they look at the underwriting. They're like, okay, yeah, I don't see how else you could push it. So I actually really like sending the analysis to the brokers.
Yeah, it makes sense, but not all the brokers view it the same way, because some are just like hung up on their underwriting because they think this is the best way we are doing it. Because I have that experience in the past. That's the reason I asked you that question. But from the passive investor's perspective, right? I'm new investor, or maybe I have invested in few deals already, and then I know what underwriting is because I heard multiple times. And then I ask you, hey, Abbas, can you send me your underwriting? So as a passive investor in that underwriting, what things I should be focusing on? What numbers are relevant to me as a passive investor? Because a
Yeah.
lot of times people get the underwriting, but they do not know what exactly is it or how you're calculating or how you're coming up with all the numbers. They're just doing the straight line calculations and they're
Yeah.
trying to match up with your underwriting, which does not match up at all.
It
So,
doesn't.
what numbers one should be paying attention as a passive investor?
I would say before the numbers, because it's going to take you a lot of time to be very proficient at underwriting. Like we're talking months and months of underwriting deals.
Exactly.
So I would say before judging, I mean, obviously you want to look at the projections and all that stuff. But if you can't understand the projections, you want to look at the person's track record, see what they've done in the past, how their deals have been performing. See if you trust them, right? And so if you can't trust someone to the point where like you have to double check every single number they have, maybe you shouldn't invest in that deal, right? If you feel that uncomfortable. So that's why, like personally, what I do is I do a lot of educational events. Every week we have a webinar. I do a lot of educational events because I want investors to really understand what we're doing. So that way, by the time we have a deal, it's like all of that is already out of the way, and they know if I have a deal, it's because I've went through every little detail before we put it under contract. And so then it makes it a lot easier because there's that trust factor in there. But yeah, I mean, I would say that's the first thing is check if you trust the sponsor and if they meet your criteria. But afterwards, I mean, if you're looking at a deal, you just want to look at the projections and where are they coming in with those projections, and they should be able to explain that on the slide deck. I mean, from the different webinars I've been to of other sponsors, everybody just says, look, these are our projections. This is how we came up with it. So almost every time the slide deck really tells me if I should invest in the deal or not. Just based on that. I rarely ever need to go through someone else's projections in terms of like getting the analysis sheet, going to the T12, then I roll myself. I just look at their slide deck. I'm like, this business plan doesn't make sense to me. I'm not investing. Or yeah, this business plan does make sense. I might invest, type of thing.
Exactly. I like that actually on that answer because it's an overall trusting in somebody's abilities that somebody's bringing you the right deal. That's what matters more than just nitpicking and all the numbers. And, it's just you're going to convolute things more and you're going to make things more complex for yourself. Thanks for saying that. So is market ambiguity affecting investors in any way in today's date? Are you getting like some kind of negative response from your investors stating that, oh, we wanted to hold on. We don't want to invest at this time. There's a lot of uncertainty in the market.
Yeah, I mean, I'm sure there's that. I mean, on the last deal that we did, we had a lot of people that sat on the sidelines because of that. Here's the interesting thing to me, right? People were funding deals and investing in deals, very quickly without second thought when the market was at a peak and everybody was investing. And then when the market goes way down in price for the same assets, right? Same asset, same exact income, but the price is now 20% cheaper. People, for some reason, are way more hesitant now than they used to be, even though the prices are way cheaper. And so to me, it's like, it reminds me of Warren Buffett. He says, listen, when I think about buying stocks like I think about buying groceries. When groceries go on discount, I don't get afraid and stop buying groceries. I go out and I buy even more groceries because they're on discount. It's the same groceries, you might as well get at the discount. And then to him, it's like stocks that are the same. It's like when I see the stock market go down, I go out and I buy even more stocks. I don't stop buying stocks. And so to me, it's the same in real estate. When the market was at a peak in 2022, everybody was investing. And I'm like, I don't know how they're making sense of these numbers. Then when the market goes down and you could get a huge price reduction, people sit on the sidelines because they see everybody else sitting on the sidelines. And so to me, those times are the best times for investors to be jumping in because we're getting huge discounts. A lot of competition is just sitting. I'm constantly looking for deals. I wasn't looking for deals last year for 6 months, but right now I'm constantly looking for deals. It's just very hard to find deals right now because a lot of sellers understand that this is kind of way lower than what it used to be, and it's most likely going to increase in the future. So a lot of sellers are holding off. But the sellers that have to sell, and there's a few of them that have to sell, they don't care about the price. They're like, let's just unload and move on. Like this property I'm going to see today. They had a family situation happen, and they're from out of the country. And so now the kids are like, we just don't want to deal with this anymore. Let's just sell it. Let's move on. We want to focus on other things in our lives.
That's true. I think every time is a good time if the things pencil in for you and the deal makes sense. Any time could be a good time, or I say
Yeah.
every time is a good time. So share one golden nugget with my audience.
One golden nugget regarding what?
Anything,
Multifamily business. Okay.
whatever
I
you like, whatever worked for you, share that brought you here, wherever you are today.
got it. I would say honestly, the lesson that has helped me the most in life is to never quit. And I constantly keep that in mind. It's like anytime I'm doing something, as long as I'm seeing some sort of traction, I will just keep at it, because one day I'm gonna figure out every mistake I've made, and then I'll start doing the right things, and that will lead me to success in that specific area. So never quitting has helped me tremendously. And anytime I get discouraged, I always think of that. I think of my first 12 months in real estate, and how if I was to quit that time, my life would have been way different now. And so to me, that's the number one lesson I always think about. Another thing that I always think about is how small I'm thinking, right? Like I sometimes
Think
go to
big.
events with these people that are multi-billionaires, and it just makes me realize, like, even though I think big, I'm just not thinking big enough. And I think that's true for all of us. I think we could all think bigger. We could all do more. And that's always at the forefront of my mind.
Yeah, I love it. Okay, never quit. Keep on taking actions and be patient, because
Yeah,
patience is the virtue here. If you want the things to happen, be patient a little bit and think big. Oh my God, I love it.
100%. And by the way, for those of you that hate the word patience, like me, I get it. I hate being patient. I'm not patient at all. But at the same time, it's like, you know, sometimes great things take a long time to happen. And so you have to sit through it. As much as I hate being patient. Although, by the way, another thing I want to emphasize too is that sometimes people listen to others say, hey, you got to be patient, and they decide to just not do anything. And that's their idea of being
That's
patient.
wrong. Mhm.
That's not true at all. You should be taking a lot of action, but be patient for the results of those actions.
That's so true, because if you're taking action and then you sit back and just see the magic happening, that's
Yeah.
what the name of the game.
Yeah.
Just don't take the actions in the right, I mean, the wrong direction either. You need
Yeah.
to figure out your vision, where you want to be, and take all the actions accordingly. That's taking you closer to your goal. But patience
100%.
still need to be there no matter what.
Yeah.
This, because everything happens it's in its own time.
Right.
You cannot just speed up certain things, so patient gotta be there. Anyways, okay, this brings us to a rapid fire round. I'm gonna ask you 5 questions. You're gonna give your answers in one word or one sentence only. Are you
Mm.
ready?
Yeah, let's do it.
All right, the first question is, what is one of the most important things that you have learned in your life that always worked for you after learning it?
That's a good question. What is one thing I learned in life that always works for me? Yeah, I mean, I think I like I said earlier, never quitting. That's always worked for me. Another thing I will add on is volume, doing a big amount of volume of things. Like I'll just give you an example of this. When I first started in the real estate sales business, I was cold calling, and people were saying, hey, you're never going to have any success with cold calling. But I
Mhm.
did. And the reason isn't because I was doing anything special or different than other people, because I did it so much. I had 2 headsets on. I was doing it for 12 hours a day. Then I hired people. I had 25 people cold calling for me. And so we were doing hundreds of thousands of calls every single day. We were doing between 100 to 200,000 per day. And so it's like, two people could work on the exact same thing, but the person that wins is the one that puts way more volume than the other person. So like nowadays, that's one of the things I always think about is, am I having a strategy issue, or am I having a volume issue? Like maybe I'm doing the right thing, I'm just not doing it enough. Right. And that's
Mhm.
very important to think about as well. I know I went over a sentence, my bad.
I love it. That's good. So, tell me one good book that you have read and recommend to my audience.
Yeah, Whatever It Takes by Steven Schwartzman. He's the CEO of Blackstone. I read that book about 4 years ago, and that's when I realized I want to be in multifamily at some point in my life. I didn't know when, but I knew I wanted to be. And so it's a phenomenal book. He talks about his journey of how he got started and how he now built one of the biggest, asset management companies in the world. I mean, they have about $900 billion of assets under management.
Great. In one word, what does life mean to you?
Hmm. One word, what does life mean to me? That's a good question. Um, I would say, I would say excellence. Pursuing the highest thing we could achieve before we die. And that to me matters most. It's like, what can I do as a human? What can I achieve? How many people can I hire? How big of a company can I build? How big of an impact can I have on the world before I die? And that's all I focus on.
I love that. That's your optimal potential, and
Yeah,
everybody has that. And now, if you can tap into that, you're invincible.
100%.
What is your biggest passion?
Building a company. To be honest with you, more than anything, I really enjoy business. I enjoy real estate, and so I just want to see what is the biggest real estate company I could build, and I love it. I'm here. I show up every day to work. I don't take any days off. I don't have any hobbies because I just enjoy what I do, and so I just want to build the biggest company before I die.
I know showing up is the number one thing. And then doing what you love. Oh my God, you cannot beat that. You got to be
Yeah.
successful no matter what. So, last question. If you could turn back in time and talk to your younger self, oh my God, what could that be like 1 year old?
I'm
What would
25 now, so it's kind of hard to go back.
what would you tell yourself?
I was on a podcast, and the guy after he did the podcast, he's like, if you were to go back to 20, at the time I was 24, he's like, if you were to go back to 25, what would you change about your life? Well, I was like, well, I haven't gotten to 25 yet. If I was to go back in time, what would I do different? I think I would have a couple of things. One is I should have started hiring people sooner. It
Mhm.
took me 2 years to realize that lesson. So and I could have had more growth in that time. So I should have hired more people sooner, and I should have gotten in multifamily sooner. At the time, I didn't realize multifamily was the way to go, and so I was just, all I was doing was building my single family business, and I realized later on that was a waste of time, really, more than anything.
Yeah, thanks. So, how can people reach out to your boss?
Yeah, I would say the best way is to make an investor account on our website. After you make an investor account, it's completely free. You'll be able to see any future deals we have. And also, you'll have the ability to book a 15-minute call with me for free. So if you go on my website, modelequity.com, again, that's modelequity.com. On the top right corner, you'll see a button that says create investor account. Click on that. It takes like 30 seconds. Just ask for your name and email. After that, you could book a call with me, and I would love to chat with you.
Thanks, Abbas. It was so much fun to chat with you today.
Appreciate you having me on.